The one big beautiful bill left federal benefits largely untouched, but there were a ton of changes done to tax deductions that will definitely help federal employees save on taxes over the next few years. In my last video, we did a high-level discussion of the different changes that the bill introduced, so in this one we'll go deeper into how the main ones work and when they expire so that you can take advantage of them before they go away. This first one was very hotly debated, and the president talked a lot about this during his campaign, and that is eliminating Social Security taxation. And frankly, that is not what we got. Okay, there's a lot of misinformation floating around on the internet. The fact of the matter is, and I talked a little bit about this in my last video, folks, this was a reconciliation bill. Okay, this essentially means that we cannot have changes to the Social Security program within a reconciliation bill. So Social Security taxation still works exactly the same way as it did for the last several decades. And very simply, Social Security is taxed anywhere from 0% all the way to 85% of your Social Security benefit is subject to Social Security tax. Okay, now, very few federal employees pay 0% taxes on their Social Security benefits. That has to do with a very, very low taxable income, which if you're a retired Fed, guess what you have? You have a FEDS annuity, right? So therefore, you've got some taxable income coming in. So as far as you're concerned, chances are you're gonna have to pay somewhere between 0 and 85% tax. This is the highest of your Social Security that is taxed. Now, the key thing that determines how much of your Social Security is taxed is something called your provisional income. Now, this is not exactly straightforward to calculate, so to save the time on this video, I put together a quick guide on how to figure out your provisional income. We're gonna put the link in the description, so if you wanna just quickly read the article, you'll be good to go. However, even though Social Security taxation didn't change, one thing that did change was the introduction of a brand new deduction, which in essence will help offset some taxes. Starting this year in 2025, there is a new $6,000 deduction per person for anyone who is 65 and up. There's a couple of conditions we need to meet, which we'll go over in just a second, but notably, since it's per person, someone who is married filing jointly, MFJ, could get as much as a $12,000 additional deduction, again, provided they are 65 and older. So in essence, this does help people with Social Security income pay a little bit less on taxes, but this was essentially the compromise they came up with since they couldn't touch Social Security at all. Now, this new law will only be in effect through 2028. So as the law is currently written, you only have 4 years to take advantage of this strategy and use it to help maximize your other financial planning strategies. For example, you might consider doing a Roth conversion of $6,000 because it equals to the same amount of deduction you might qualify for. So for example, let's say your modified adjusted gross income, MAGI, is $130,000, okay? And let's say this is just a combination of your FEDS annuity plus retirement account distributions, so TSP or IRAs, things like that. If you were to do a $6,000 Roth conversion, ordinarily, this would take your income to $136,000, which if you are on Medicare Part B, that is high enough that it may bump you into the next Medicare bracket. And so now all of a sudden you're paying more for health insurance. Now with this new deduction, we have an additional $6,000 deduction in here that effectively takes your income back down to 130 again. And now not only did you effectuate a Roth conversion, you are able to do so while staying below the certain income bracket. And so this is one way that you might think of using this new deduction in your planning. Because again, remember, if you do this $6,000 times 4 years, that's $24,000 that you can get into a Roth IRA. And then you can invest this account totally tax-free for growth if you want, so that it's there later for you in life to be able to use for medical expenses or leave as a legacy and all sorts of things. Remember, completely tax-free. This is a really smart strategy that I know we're gonna start using with clients. Now, do be aware that you do owe taxes on the Roth conversion, so your tax liability might go up a little bit. But again, that's not the bigger picture here. There's a whole lot of other things as it relates to your lifetime tax liability that are much more important than increasing your taxes by just a little bit for 1, 2, 3, or 4 years. How much growth can you get in this account long term and never owe taxes versus if it had just been inside your pre-tax accounts? Now, the last detail to know about this is that this is subject to phase outs. In other words, the more income you have, eventually you reach a point where the benefit of $6,000 for an individual or $12,000 for a couple, you start to have less benefit depending on your income, and eventually it goes away altogether. So let's check out these numbers. So the way this works for married filing jointly, we have a $12,000 deduction, as you recall. For single, we have a $6,000 deduction. And your level of income is going to determine this, okay? So from 0 all the way to $150,000 of your Magi, hey, you get the full $12,000 benefit, or 6 if you file single. Once you hit these thresholds, respectively, this is when you enter the phase out period. And so between that and all the way until you hit the top end of the threshold, you're going to earn less and less deduction, eventually not earning any deduction at all once you reach $250,000 and $100,000 for married filing jointly or for single. Okay, so this is how a phase out works. You'll notice many of these other deductions we'll talk about today have a phase out component. So I wanted to at least show you how this works. The next one, the SALT deduction, which stands for state and local tax deduction, has now quadrupled. Prior to this law, we had a $10,000 cap on how much you can deduct from your federal income taxes. This has now been put to $40,000, which is a pretty substantial jump. In short, the SALT deduction allows any local taxes like state income tax or property tax that you may have paid, you can deduct that from your federal taxes to help you reduce your overall tax liability. So for any homeowners, especially here in the DC area, Maryland, Virginia, DC, or even in some other high tax states like California, where we've got lots of clients, New York, other places like that, New Jersey is one, then this increase is likely going to be very beneficial for you. Now, of course, like with most deductions, we have phase outs again, and it is my understanding that at least the way the law is interpreted right now, it is the same for married filing jointly and single, which is not very common. Mostly there is a difference between the two. But again, from 0 to $500,000 of income, you get the full $40,000 benefit until you start getting a phased out amount. And then at $600,000, you no longer get that benefit at all, except for there is a floor, which is interesting. You do still get a $10,000 minimum SALT deduction, okay, but you don't get the full $40,000 like someone with less income. Now, for most federal employees and retirees, this $600,000 income threshold, that's pretty high. Until you have someone who works in the private sector, maybe a partner at a law firm or some other field that may have a high earning potential. If it's a dual income situation, we might be seeing these numbers pretty easily. So just something to be aware of. Now, this one also starts in 2025 and will run for 4 years as well. So I would encourage everyone to go back when you file your taxes next year, see if an itemized deduction might actually be beneficial for you. Okay, that's one condition of a SALT deduction. It is below the line. So remember in the last video, we talked about line 11 being the line where any deduction that is below the line, like the SALT deduction, you have to itemize your deductions in order to benefit from it at all. So take a look to see if next year when you file your taxes, you might not want to itemize instead. So for example, here in Montgomery County, MoCo, let's say you paid $10,000 in the year for your property tax, and let's just say Maryland state income tax was another $15,000 or so. Okay, well, that combines to $25,000. Hey, you know what? That's over the previous limit, but under the new limit. So all of a sudden, this might be a pretty big deduction that if you combine with other deductions, may be over the standard deduction for married filing jointly, which is just over $31,000 for the year. Up until now, there was very little tax benefit that you would receive from making charitable contributions unless you itemized. Well, under this new bill, now not starting this year, but starting in 2026, if you made any charitable contributions up to $2,000 for married filing jointly or $1,000 for single, you're able to deduct 100% of this contribution amount to charity, even if you don't itemize your deductions. We call this an above the line deduction, which we like. Now here's a pro tip. Ready? Keep your receipts. Just because you are now doing it above the line and you're not itemizing it anymore doesn't mean you don't need to have the appropriate documentation for this. So you still need to be able to substantiate the value of the donation that you've made so that you can count it towards your taxes. But all in all, this is pretty beneficial because still taking the standard deduction for most people will be the right answer for them. And so now, as long as they're still making those charitable contributions, hey, they get to benefit from that on a tax perspective a little bit more. Now, the car loan interest deduction is fairly interesting. I touched on it in my last video, but here's the breakdown and let's get into how this actually works. This one is a brand new one this year, and just like the last one, it is an above the line deduction, so no need to itemize your deductions to benefit from this. Now, the way this one works is essentially if you have a car loan, the payments that you're making towards that car come with some sort of interest charge, right? So let's say your car payment is $500 a month, maybe 425 of that goes towards the principal and the other 75 might go towards the interest of the loan that you have. With this new law, you may be able to deduct this additional interest that you're paying from your tax liability. So if you've ever had a mortgage, this is very similar where the interest paid on the loan for your mortgage is deductible from your taxes. Except here's the difference. Your mortgage interest deduction is a below the line deduction. So you have to itemize your deductions to benefit from that. Okay, so this car interest loan deduction does not have that same feature. In other words, it is above the line, so you don't have to itemize, which is really nice. And so here's an example of how this works. Again, let's say your mortgage interest was $20,000 for the year, and then your other deductions, just making up numbers here, was $8,000 for a total of $28,000. Well, if the standard deduction for married filing jointly is just over $31,000, why would you itemize your deductions to get your mortgage interest deducted? Because that's going to be less than your overall standard deduction. So there really wasn't any benefit in you doing that. However, because the car loan is an above the line, you don't need to itemize to actually benefit from this. So you could still get the full $31,150 standard deduction for MFJ. And let's say that the interest that you paid over the year was $1,500 of interest on the car loan. Because it's an above the line deduction, now you get to add these two deductions together and you actually have a slightly higher overall tax deduction on your return. So this one is pretty interesting, but of course there are conditions that need to be met for you to qualify for this. Number one, the car has to be assembled in the United States. Now, I can already tell you there is going to be all kinds of back and forth with the IRS about how much was assembled in the US and which parts came from the US and what percentage of the vehicle needed to be assembled in the US. This is going to go on and on and on, and we're going to get clarifying language, I imagine, as time goes on. And again, like most deductions, we are looking at phase outs here. So for married filing jointly and for single, we've got two different income phase out ranges. So up to $200,000 for MFJ, you get the full interest deduction, and then you start phasing out. And then again, once you hit the high end, you can no longer take that deduction altogether. This one is slightly different. It's a 20% reduction for the dollars over the phase out limit. So just make sure you're careful about calculating how much you qualify for. And again, this too is also available for 4 years only, starting this year through 2028. So make sure that if you are taking advantage of this, it is a vehicle that you need to have initiated the loan either this year through 2028 to be able to benefit from this. So that's it for this one, folks. Remember that we're covering many new strategies that are going to be available with this new bill going forward. So if you've not yet subscribed to the channel, now's your chance to do so. And until next time, stay wise and stay wealthy.